The dot-com bubble, when rabbits bought air. Year, March 10th, 2000. Stock market hits all-time high. Every rabbit in the country is rich. On paper. Rabbit opens his investment account. 3 months ago, Rabbit put in 10,000 leaves. Today it shows 45,000. Rabbit has made more money sitting at his desk clicking a mouse than he makes at his actual job. Rabbit's neighbor is rich too. Rabbit's barber is rich. Rabbit's dentist quit dentistry to trade stocks full-time. Everyone is a genius. Everyone is getting rich. Everyone knows it will never end. 6 months later, Rabbit opens his account again. 45,000 is now 6,000. Rabbit stares at the screen, refreshes. Same number. Refreshes again. 6,000. Rabbit just lost 39,000 leaves in 6 months on companies that never made a single penny of profit. This is the story of the dot-com bubble, the greatest financial hallucination in modern history. When rabbits invested trillions of leaves into ideas, not businesses, not profits, not products, ideas, and then watched it all disappear. Part 1. The Spark, 1993 to 1996. To understand how rabbits lost their minds, you need to understand what happened first. 1993. Something new appears, the World Wide Web. Before this, the internet exists, but only for university rabbits and military cats. Regular rabbits have never seen it. Regular rabbits don't know what it is. Then Mosaic browser launches. For the first time, any rabbit with a computer can go online. Click a link, see a picture, read a page. It's slow. It's ugly. It's revolutionary. 1994. A rabbit named Jeff opens a website that sells books. Online. From his garage. He calls it Amazon. People think he's crazy. Why would anyone buy a book without holding it first? Another rabbit opens a website where strangers can auction things to each other. He calls it eBay. People think he's crazy too. Why would anyone buy used junk from strangers? 1995. A company called Netscape makes a web browser. Netscape decides to sell stock to the public. IPO day, August 9th, 1995. Opening price, 28 leaves per share. End of first day, 58 leaves per share. Doubled in 1 day. Netscape has almost no revenue. Netscape has no profit. Netscape gives away its browser for free. And the stock doubled on day 1. Wall Street notices. Every investment bank cat notices. Every venture capital cat notices. And something clicks in their brains. You don't need profit to sell stock. You just need the internet. This changes everything. 1995 to 1996. The internet gold rush begins. Suddenly, every rabbit with an idea wants to start an internet company. And every investor cat wants to fund one. The logic goes like this. The internet is new. The internet will change everything. Therefore, any company with a website will be worth billions. Eventually. Somehow. Nobody asks how. Nobody asks when. Nobody asks the most important question in business. How will this company actually make money? Because in 1996, that question doesn't matter. What matters is growth, users, clicks, eyeballs, page views. Get big fast. Figure out money later. Venture capital cats are throwing money at anything. 2 rabbits walk into a VC office. They have a PowerPoint presentation. Slide 1. We're building a website. Slide 2. For pet food. Slide 3. Online. Slide 4. We need 50 million leaves. VC cat. How will you make money? Rabbit. We'll figure that out after we get big. VC cat writes a check. This actually happened. The company was called Pets.com. We'll come back to it. Part 2. The Mania. 1997 to 1999. This is where rabbits lose their minds. 1997. Amazon goes public. IPO price, 18 leaves per share. Amazon is losing money. Lots of money. But it's growing. Users are signing up. Orders are increasing. Stock goes up. 1998. Amazon stock, 300 leaves per share. Amazon is still losing money. More money than before, actually. Stock goes up more. Rabbits start to notice. The rabbit who bought Amazon at 18 now has 16 times his money in 2 years, without Amazon ever making a profit. Rabbits tell other rabbits, "You have to buy internet stocks. They only go up. My cousin put in 5,000 leaves and now has 80,000. It's free money." The fever spreads. 1998 to 1999. Everyone becomes a day trader. Day trading used to be for professional cats on Wall Street. Now, any rabbit with a computer and a phone line can do it. New online brokerages appear. Trade for 10 leaves instead of 100. No experience needed. No knowledge needed. Just click buy. Rabbit quits his accounting job, opens a trading account with 20,000 leaves. Day 1. Buys internet stock at 10, sells at 14. Profit, 4,000 leaves. In 1 day. Rabbit made more in 1 day of trading than in 2 weeks of accounting. Week 2. Rabbit does it again. And again. Month 1. Rabbit has doubled his money. Month 2. Rabbit tells everyone he's a trader now. Month 6. Rabbit has 200,000 leaves. Started with 20,000. Rabbit is a genius. Rabbit reads no financial reports. Rabbit doesn't know what revenue means. Rabbit doesn't need to. Everything he buys goes up. Rabbit buys a stock because the name sounds techy. It goes up. Rabbit buys a stock because his barber mentioned it. It goes up. Rabbit buys a stock because it has .com in the name. It goes up. There is no skill here. There is only a bubble inflating. And every rabbit inside the bubble thinks he's flying. The companies. Let's talk about what rabbits are actually buying. CarrotDelivery.com. Founded 1998. Idea: deliver carrots to your door via website. Revenue: 3 million leaves per year. Losses: 50 million leaves per year. Stock market value: 800 million leaves. A company that loses 50 million per year is worth 800 million. Because growth, because internet, because future. Burrowfinder.com. Founded 1999. Idea: help rabbits find burrows online. Revenue: 0. Employees: 200. Offices: downtown, with ping pong tables and free lunch. Stock market value: 1.2 billion leaves. 1.2 billion. For a company with 0 revenue. The logic? They have 2 million users. If they figure out how to charge just 1 leaf per user, that's 2 million in revenue. And users are growing 300% per year. If they figure it out. If. Digcarrot.com. Founded 1999. Idea: sell gardening tools online. Revenue: 200,000 leaves. Marketing budget: 20 million leaves. They spend 100 leaves in marketing for every 1 leaf in sales. Stock market value: 400 million. At a party in San Francisco, 1999, every rabbit is talking about their internet company. We're pre-revenue, but we have incredible user growth. Pre-revenue. That's a fancy way of saying we make 0 money, but it sounds smart at a party. Pets.com, the perfect symbol. Remember those 2 rabbits with the PowerPoint about online pet food? They got funded. They got more funding. They got even more funding. Total invested? Over 300 million leaves. Pets.com sells pet food and supplies online. The problem? A 20-leaf bag of pet food costs 15 leaves to ship. They're literally losing money on every order. The more they sell, the more they lose. But they're growing. Growth is all that matters. Pets.com spends millions on a Super Bowl commercial. A sock puppet becomes their mascot. Everyone knows the sock puppet. The brand is everywhere. Pets.com goes public. February 2000. IPO price: 11 leaves per share. Rabbits rush to buy. 9 months later, Pets.com stock: 19 cents. From 11 leaves to 19 cents. 300 million leaves of investor money. Gone. The sock puppet is more valuable than the company, But we're getting ahead of ourselves. Before the crash, the mania gets even crazier. Part 3. The Peak. Late 1999 to March 2000. December 31st, 1999. New Year's Eve. Rabbits are celebrating the new millennium and celebrating their stock portfolios. The Nasdaq, the stock market where internet companies trade, is at 4,000. It was at 1,000 4 years ago, up 300% in 4 years. But the best is yet to come. January 2000, stock market goes vertical. Not up, vertical. Companies are doubling in a week. Rabbit, who was a teacher 3 months ago, now has 500,000 leaves in internet stocks. Rabbit puts down payment on a luxury burrow. Rabbit buys a new car. Rabbit is planning early retirement. Rabbit is 28 years old. Teacher Rabbit shows up to school parking lot in a new convertible. Principal sees it, walks over. How do you afford this on a teacher's salary? Teacher, internet stocks. You should get in. Principal opens a trading account the next day. By 2002, both are broke, the teacher and the principal. That's how manias spread, not through logic, through parking lots. Everyone has a story like this. Everyone at every dinner party. Everyone at every barbecue. My portfolio is up 400%. I just bought more Yahoo. Have you heard of this new company? It's going to be the next Amazon. Media is pouring fuel on the fire. Magazine covers. Get rich now. How internet stocks will make you a millionaire. TV shows about day trading. Books about how the old rules of investing no longer apply. The old rules. Buy companies with profits, reasonable prices, solid management. The new rules. Buy anything with .com in the name. Profits don't matter. The internet changes everything. Analysts at big investment banks are on TV every day. Buy, buy, buy. They rate every internet stock a strong buy. Why? Because their banks make millions taking these companies public. If analysts say, this stock is garbage, the company takes its IPO to a different bank. So analysts lie. They lie on TV. They lie in research reports. They call stocks strong buy in public and piece of junk in private emails. This isn't speculation. This actually happened. The emails were found later. March 10th, 2000. Nasdaq hits 5,048, all-time high, the peak. Nobody knows it's the peak. Everyone thinks it's just the beginning. A few rabbits notice something, the smart ones, the ones reading financial statements instead of watching TV. Smart Rabbit looks at the numbers. All these companies combined, losing billions per year, burning through cash like it's on fire. Most have enough cash for 6 to 12 months. After that, dead, unless someone gives them more money. Smart Rabbit tells his friends, these companies have no profits. Most will go bankrupt. Friends laugh. You just don't get it. The internet changes everything. Old rules don't apply. Smart Rabbit sells everything, moves to cash. Friends think he's an idiot. Part 4. The Crack. March to May 2000. March 13th, 2000. 3 days after the peak. Japan announces their economy is back in recession. Global markets wobble. A few big investors decide to take profits, sell some internet stocks, lock in gains. Nothing dramatic, just smart money getting cautious. But the market is built on leverage. Many rabbits bought stocks with borrowed money, margin accounts. Here's how it works. Rabbit has 50,000 leaves, borrows another 50,000 from broker, buys 100,000 in internet stocks. Stocks drop 30%, portfolio worth 70,000. But Rabbit still owes 50,000. Rabbit's actual equity, 20,000. Broker calls. Deposit 15,000 leaves or we sell everything. Rabbit has 2,000 in savings. Broker sells everything. At the worst possible moment. Some owe more than they get back. Invested. Some owe more than they get back. Invested to get rich. Ended up in debt. When prices drop, brokers call. Your account is below minimum. Deposit more leaves or we sell your stocks. Rabbit doesn't have more leaves. Broker sells. Selling pushes prices lower. Lower prices trigger more margin calls. More forced selling. Prices drop more. The spiral begins. March 2000. NASDAQ drops from 5,048 to 4,200. Just a correction. Buy the dip. Rabbits buy more. April 2000. NASDAQ drops to 3,300. Okay, this is a real dip. But the internet isn't going anywhere. Hold. Rabbits hold. Some buy even more. Stocks are on sale. The bargain hunters. The buy the dip crowd. They think they're smart. They're catching a falling knife. Because the internet isn't the problem. The internet is real. The internet is revolutionary. The problem is the prices. Companies worth zero are priced at billions. And reality is finally showing up. May 2000. First internet companies start dying. Small ones first. Companies nobody's heard of. Running out of cash. Can't raise more money because investors are scared now. They close quietly. 200 employees show up Monday morning. Doors locked. Email from CEO. We have ceased operations effective immediately. Go home. This happens once, then twice, then every week, then every day. Part 5. The Avalanche. 2000 to 2001. Summer 2000. The dying accelerates. Companies that were worth hundreds of millions are going bankrupt. Not slowly, overnight. Cash runs out. Doors close. Everyone fired. The problem is now obvious to everyone. These companies spend more than they earn. Most earn nothing. They survive on investor money. When investor money stops, they die. And investor money has stopped. Venture capital cats are not writing checks anymore. The stock market is not buying IPOs anymore. There is no more money for companies that don't make money, and almost none of them make money. The death list grows. Pets.com, dead. 300 million leaves burned. Webvan, online grocery delivery, dead. 800 million burned. Cosmo, 1-hour delivery service, dead. 280 million burned. eToys, online toy store, dead. Spent 120 million to earn 30 million. Boo.com, online fashion, dead. Blew through 188 million in 18 months. drcoop.com, online health, dead. Flues.com, online currency, dead. Govworks.com, dead. Every week, more names on the list. Every week, more rabbits unemployed. Every week, more investors watching their portfolios shrink. By October 2000, NASDAQ at 3,000, down 40% from the peak. Rabbits are nervous, but still holding. It'll come back. It always comes back. By December 2000, NASDAQ at 2,400, down 52%. Rabbits are scared now. Some start selling. Selling pushes prices lower. Lower prices scare more rabbits. More selling. The psychology flips. 6 months ago, buy, everything goes up. Now, sell, get out before it hits zero. Same rabbits, same stocks, opposite behavior. Because rabbits don't make rational decisions. Rabbits follow emotions. Greed on the way up, fear on the way down. 2001. It gets worse. January 2001. Massive layoffs begin. Not just internet companies, real companies, big companies, companies that supply internet companies, companies that advertise on internet websites, companies that make servers and routers and cables. The entire technology ecosystem is collapsing. Silicon Valley goes from boom to ghost town. Office buildings that were full in January are empty by March. For lease signs everywhere. Parking lots empty. Restaurants closing. Then, September 11th, 2001. Terror attacks. Stock market shuts down for a week. When it reopens, everything crashes further. NASDAQ falls below 1,500, down 70% from peak. Rabbit's 45,000 leaf portfolio is now worth 6,000. Rabbit hasn't sold. Rabbit kept holding, hoping, waiting for it to come back. It didn't come back. It won't come back, because most of those companies don't exist anymore. Rabbit's money didn't go down, it disappeared. The companies went to zero. You can't recover from zero. Part 6. The Bottom, 2002. October 2002. NASDAQ hits 1,114, down 78% from the peak. 5 trillion leaves of stock market value, erased. 5 trillion leaves. That's not a typo. 5 trillion leaves disappeared in 2.5 years. Retirement accounts, destroyed. College funds, gone. Life savings, evaporated. The day trading rabbit, the one who quit his accounting job, who turned 20,000 into 200,000, by late 2001, he has 4,000 leaves left, less than he started with. He's applying for his old accounting job back. They're not hiring. Nobody is hiring. The teacher rabbit, who had 500,000 and bought a luxury burrow, portfolio is now worth 60,000. Can't make mortgage payments. Loses the burrow. Goes back to teaching. If there's a job. Schools are cutting budgets too. One Sunday, teacher rabbit is cleaning the garage. Finds a box in the corner. Opens it. Stock certificates from 1999. drcoop.com. eToys. Pets.com. Beautiful paper. Official seals. Gold lettering. Worth 0. Every single one. Teacher rabbit stares at them for a long time. Then takes them to the backyard. Lines his pet rabbit's cage with them. Most expensive rabbit bedding in history. The startup founders built companies worth billions on paper. Hired hundreds of rabbits. Promised stock options that would make everyone rich. Stock options. Worthless. Companies. Bankrupt. Founders. Some broke, some embarrassed. A few quietly rich because they sold early and didn't tell anyone. The venture capital cats? Many lost their funds' money. Some lost everything. A few made incredible returns because they invested early in Amazon or eBay, companies that actually survived. Because here's the thing about the dot-com bubble. The internet was revolutionary. Amazon did change shopping. Google did change information. eBay did change commerce. The technology was real. The revolution was real. The prices were insane. Buying Amazon at 18 leaves and holding through everything, that turned into a fortune. Amazon today is worth thousands per share. But buying Pets.com at 11? 0. Buying eToys at 80? 0. Buying Dr. Coop at 45? 0. The difference between a good investment and a catastrophic one wasn't the internet. It was whether the company could actually make money. And in 1999, nobody cared about that question. Part 7. Who profited? While regular rabbits lost everything, some cats got very rich. The investment banks. Every internet company that went public paid fees to an investment bank. IPO fees. 7% of total money raised. Company raises 100 million? Bank takes 7 million. Hundreds of IPOs. Billions in fees. Banks collected fees whether the company survived or not. Pets.com goes bankrupt? Bank already has its 7 million. Webvan dies? Bank already cashed out. The investment bank cats who recommended these stocks on TV? They got bonuses, while their customers lost everything. They got bonuses for bringing in IPO business. The executives. Startup CEOs took massive salaries. Some took millions per year from companies that had zero revenue. Many sold their personal stock before the crash, when they knew the company was dying, while telling employees to hold. Employees held. Stock went to zero. CEO had already cashed out millions. The venture capitalists. Smart VC cats invested early at low prices. When companies went public, VC Cat's shares were worth 10 times, 50 times, 100 times what they paid. Many sold during the IPO, or shortly after, before the crash. Regular rabbits bought at IPO prices, high. VC Cats sold at IPO prices, high. Transfer of wealth, from regular rabbits to connected cats. The analysts. Remember the TV analyst who said, buy, buy, buy? Internal emails revealed later, one analyst rated a stock strong buy publicly. His private email about the same stock. This is a piece of garbage. Another. I can't believe anyone buys this junk. They lied. Because their banks made money from the lie. Some were fined later. Small fines. Nobody went to jail. Part 8. The lessons. Lesson 1. If a company doesn't make money, it's not worth money. Revenue is not profit. Users are not customers. Growth is not success. A company that grows 300% per year but loses money on every sale is not a good business. It's a fire that burns faster the bigger it gets. In 1999, rabbits forgot this. They will forget it again. Lesson 2. When everyone is getting rich doing the same thing, it's a bubble. Your barber is trading stocks. Your dentist quit to day trade. Your neighbor who failed math is giving investment advice. That's not a bull market. That's a mania. And manias always end the same way. Lesson 3. This time is different is never true. 1999. The internet changes everything. Old rules don't apply. The internet did change everything. The old rules still applied. Companies still need to make money. Prices still need to make sense. Gravity still works. Every bubble has a "this time is different" story. The technology is always real. The prices are always insane. Both can be true at the same time. Lesson 4. The people telling you to buy are selling. Analysts say buy because their banks make money from IPOs. TV hosts say buy because fear doesn't get ratings. Your friend says buy because it validates his own decision. Nobody who is selling will tell you to sell. Everyone who is buying wants you to buy. Follow the incentives, not the advice. Lesson 5. The best time to invest is when everyone is afraid. March 2000. NASDAQ at 5,000. Everyone buying. Terrible time to invest. October 2002. NASDAQ at 1,100. Everyone terrified. Best time to invest. The rabbit who bought an index fund at the bottom of the crash and held for 20 years made a fortune. Not from picking the next Amazon, just from buying when everyone else was selling. Fear is the best sale price in the stock market, but almost nobody can buy when they're afraid. That's why almost nobody gets rich. Lesson 6. Most of the money was real. The losses were real. The lessons were ignored. 2008. Housing bubble. Same pattern, different asset, same result. 2021. Crypto and meme stocks. Same pattern, different asset, same result. Greed, bubble, crash, repeat. Every generation thinks they're different. None of them are. Part 9. The Echo Year. 2025. Rabbit is scrolling social media. Every other post, AI companies. Every other headline, AI will change everything. Every other conversation, have you invested in AI stocks? Rabbit's friend just made 200,000 leaves on AI stocks in 6 months. Rabbit's coworker quit to start an AI company. Rabbit's barber is talking about buying AI stocks. Sound familiar? AI is real. AI will change things. Just like the internet was real. Just like the internet changed things. But in 2000, the internet being real didn't stop rabbits from losing 5 trillion leaves on companies that sold air. The technology is never the problem. The prices are the problem. The mania is the problem. The belief that this time is different is the problem. Old Rabbit, the one who lost everything in 2000, sees his son scrolling AI stock tickers. Son is excited. Dad, look! This AI company went up 400% this year. I'm putting everything in. Old Rabbit gets that cold feeling in his stomach. He's felt it before. 25 years ago. standing in front of a computer screen, watching numbers turn red. Son, yeah? Does the company make money? Son pauses. Not yet, but they have 50 million users, and they're growing 200% per year. Revenue will come. Old Rabbit closes his eyes. Same words, different decade. Be careful. Son laughs. You're paranoid, Dad. This isn't 2000. Technology is different now. These are real companies with real products. Old Rabbit says nothing, because Old Rabbit remembers. Old Rabbit remembers when Pets.com had a real website, and real customers, and real products, and real Super Bowl commercials, and went to zero. The question was never, is the technology real? The question was always, is the price real? And in a Mania, nobody asks about price, because price doesn't matter when everything goes up, until it does. 2 questions. That's all you ever need. Does this company make money? Is the price reasonable? If the answer to either is no, walk away. No matter what your barber says, no matter what TV says, no matter what everyone at the party says, walk away. Or don't, and learn the lesson the expensive way, like 5 trillion leaves worth of rabbits did in 2000. The market doesn't care about your feelings. The market doesn't care about your story. The market only cares about math, and math always wins. Rabbits together strong.